Hey everyone, welcome back to another video. This is My Financial Focus, and in today's video I'm going to be doing an in-depth analysis of Google's business model. I'm going to look at their annual report and look at their financial statements, as well as some of the aspects of their business that I think are important to touch upon when analyzing a business from an investment perspective. And then I'm going to use their cash flows from their statement of cash flows to use a discounted cash flows model to find their intrinsic value, or just estimate their intrinsic value from a value investing perspective and create a margin of safety like many value investors like Warren Buffett and Peter Lynch and Charlie Munger do as well, in order to see what a good buying price would be for me if I wanted to buy into Google stock. So the first thing I want to look at is how Google makes money. This part of the annual report specifically talks about how their main sources of revenue are their advertising platform as well as their Google Cloud products. Their advertising platform is world-class and it's one of the best advertising platforms on the market. It allows for businesses and individuals to market their products and services digitally through Google Ads as well as through YouTube ads and different Google networking products. And with their Google Cloud business, many of the products that we might be familiar with their Google Cloud business are Gmail, Docs, Drive, Calendar, Meet, and much more. So the second thing I want to look at are their financial statements. We can see right here, this is Google's balance sheet. I want to look at a couple of things here. We can see that their total current assets are 174 billion in 2020, which is an increase from 152 billion in 2019. The total cash they have on hand is about 119 billion, or it was in 2019, and it's now 136 billion. So total cash makes up a pretty considerable amount of their total current assets, as well as a pretty considerable amount of their total assets in general, which is a great sign because cash is liquid, and having liquid assets definitely puts a business in a strong financial position in the case of an economic downturn. We can see that their total current liabilities are 45 billion in 2019 and 56 billion in 2020, and their total liabilities in 2019 were 74 billion and up to 97 billion in 2020, with their total stockholders' equity increasing from $201 billion in 2019 to $222 billion in 2020. Now onto their income statement. I want to break down this specific column right here, their revenues, which I will directly after this, because I want to figure out how much of their revenue is made up specifically of YouTube ad revenue, and I also want to figure out where in the world most of their revenue is located and what percentage allocation that makes up of their total revenues. So we can see on their income statement in 2018, their total revenues accounted for $136 billion, and in 2020, it increased to $182 billion, with their net income, their bottom line, being $30 billion in 2018 and increasing to $40 billion in 2020. So now I'm going to move on to their statement of cash flows, which we can see right here. And this is basically just a quick little glimpse at how Google spends their cash, how much cash they generate from their operations, which we can see right here, their operating activities. The net cash provided by their operating activities in 2020 was $65 billion, up from $54 billion in 2019 and $47 billion in 2018. So there's definitely strong growth from their operating cash flows over the recent years. Cash flow statement also goes over their net cash used in investing activities, which I will break down a little bit after this as well, including the revenue that I previously said I would break down. We can see that in 2018, they spent $28 billion on investing activities, and in 2020, they spent $32 billion. And lastly, on their statement of cash flows, we can see their financing activities, which is how much money they spend on financing, which I'll also go over directly after this in more detail. We can see in 2018, they spent $13 billion, and that's up to $24 billion in 2020, with their ending cash position at 2020 after expenses being $26 billion. So now this is the sheet that I wanted to look at that goes into detail for Google's revenues. We can see that through ad revenue from the Google search bar and other aspects of that nature, we can see that their total revenue from that was $104 billion in 2020, up from $98 billion in 2019. So definitely some significant growth there. And we can see that from their YouTube ad revenue, they had $19 billion in 2020, up from $15 billion in 2019, with their total revenues after adding in their revenues from Google Network member properties as well as their Google Cloud services being $182 billion in 2020, up from $161 billion in 2019. We can see if we scroll down a little bit, YouTube ad revenues increased 4.623 million, or no, this is $4 billion, sorry, because it's 1 million times the 4,000. From 2019 to 2020, growth was primarily driven by our direct response advertising products, which benefited from improvements to ad formats and delivery and increased advertiser spending. And obviously, COVID-19 had an impact on a lot of businesses, so there was less ad spending during that time period, which impacted their bottom line. But despite that, they still had an increase in ad revenue. Next thing that I want to look at is their debt obligations. We can see that their short-term debt comes out to up to $5 billion. And in terms of long-term debt, there are a couple of figures here that we can analyze, but I'm more so interested in what the debt is actually made up of, which we can see right here, $5.75 billion designated as sustainable bonds, the net proceeds of which are used to fund environmentally and socially responsible products in the following 8 areas: energy efficiency, clean energy, green buildings, clean transportation, circular economy and design, affordable housing, commitment to racial equity, and support for small businesses and pandemic crisis response. The next thing that I want to look at is their breakdown of their cash flows. So right here we can see their bottom line values for their net cash provided by operating activities, investing activities, and financing activities, with there being a positive cash inflow after expenses. Their cash from operating activities is primarily made up of advertising revenues from YouTube and Google search ads, with less of that made up from their Google Cloud offerings and subscription-based products. Their cash used in investing activities came from their sale of marketable and non-marketable securities, as well as their investments in property and equipment. And their cash from financing activities came from repayments of debt, repurchases of capital stock, as well as stock-based award activities. And we can see that part of their investment activities include acquisitions, and one of the acquisitions that they made in 2020 was the acquisition of Fitbit, or in January 2021, which they closed, Fitbit being a leading wearable brand that's worth $2.1 billion. One thing I really like about Google's annual report is how open they are with their risk factors. And so I'm just going to skim through this really quickly just to see what some of their primary risks are to the future growth of their company, which is something that as a value investor, we should be very interested in. So we can see that they generate a significant portion of their revenues from advertising, and reduced spending by advertisers, a loss of partners, or new technologies, or blocked ads online could definitely affect their bottom line greatly because of how dependent they are on their ad revenue. They face intense competition, and if they do not continue to innovate, they will most likely be replaced, or their bottom line will be greatly affected. They make ongoing investments in new businesses, products, services, and technologies which are inherently risky and may not work out. Their revenue growth rate could decline over time, and they anticipate downward pressure on their operating margin in the future. So there's many different risks that they talk about in their annual report, and I'll just skim through them like this, so in case anybody wants to pause the video, they can, and they can read through them. But honestly, if I read through all of these, the video would be about an hour long, so I'm not going to do that. But this is just a quick overview of some of the risks that are posed to Apple's business, or Google's business, sorry, I don't know why I said Apple. This right here is a summary of their income taxes. We can see that from their domestic operations, they paid about $37 billion in income taxes, and from their foreign operations, they paid about $10 billion in income taxes. And I forgot to mention one more thing that I wanted to look at when referring to their revenues, which is their revenues by geography. We can see that in the United States, their revenues, a percentage of their revenues was 47%, with 53% of their revenues coming from the rest of the world, EMEA and APAC. I believe EMEA is Europe, the Middle East, and Africa, and APAC is Asian Pacific, Americas, and one more that I've forgotten. Okay, so that's basically a summary of their annual report. Now what I'm going to do is use a discounted cash flows model in order to try to figure out the intrinsic value of their business. So right here, I have my intrinsic value calculator on Excel. And what this basically is, for those of you who don't know what a discounted cash flows model is essentially what I'm trying to do here is figure out, or just make assumptions about what Google's cash flows for the next 10 years will be, and then discount them back at a percentage that I'm looking to get as a return on my investment over time. So basically, this is saying that if I receive $1 today, it's worth more than if I receive $1 10 years from now, because the $1 today I can then use to invest and get a 10% return, and 10 years from now that $1 would be worth a lot more. So getting $1 10 years from now, we would want to discount that back to today to figure out how much money we would have to spend today, invested over 10 years at a 10% annual return, to have $1 10 years from now. So what we're going to do for Google in this case is we're going to pull up a couple of statistics, like their growth rate, their year one free cash flow, their net cash minus their, or divided by their net debt, as well as their shares outstanding, in order to try to figure out their free cash flow. A place that we can go to figure out their growth rate really quickly is through analysts' growth estimates on Yahoo Finance. We can see right here for Google's analysts' growth estimates for the next 5 years is 24.41%. So I'm just going to type that in right here. And for their growth rate for years 6 to 10, I'm going to be a little bit more conservative and just say like 10%, for example. These are all just ballpark estimates about Google's intrinsic value. Feel free to play around with these values in order to figure out for you what a good buying price would be for you for your particular investment criteria. Then I'm going to look for their year one cash flow. An easy way to find this is just by going to TradingView and looking at their cash flow statements, and scrolling down, we can see that their free cash flow for the year ending in 2020 was $42 billion. So I'm going to put that in right here. It was 42,000,000,084. Now I want to look at their net cash divided by their net debt, or minus their net debt. And the way I can do that is just going to Yahoo Finance, their balance sheet. We can see their total cash was 135.86 billion. So I'm going to say minus their net debt, which is 28.1 billion. And we can see that their net cash minus net debt comes out to 107.76 billion. And after putting these calculations in, we can see that the value of Google, of their free cash flows after 10 years, their terminal value is essentially just what the business would be worth if we sold it in year 10. So this is just a multiple of their free cash flow. We can see right here that it would be, this is multiplied by billion, so whatever that number would be. And the way we figure out what the price would be to buy into the business is by dividing this number by their shares outstanding, which we can find right here, which is 320 million shares. So right here we can see that after calculating what their business is worth and dividing it by the outstanding shares, we wouldn't use these numbers right here because this is in billions, and since the shares outstanding is in millions, we need to convert it to millions. It's essentially the exact same numbers. We're just multiplying this by 1,000, and we can see that the intrinsic value in millions is this number. I believe that says it's going to be that's a big number. I have to multiply this number by 1 million essentially. So yeah, and their intrinsic value per share according to their discounted cash flows is $4,111 with a 30% margin of safety of $2,878 and a 50% margin of safety being $2,055. Now keep in mind that this discounted cash flows model makes a lot of assumptions. It assumes that Google's growth rate over the next 5 years will be 25%, and it also assumes that Google's free cash flow will increase at this rate and return us a return on our investment of 10%. So it's really just one tool of many tools that we can use to derive intrinsic value, but it may not be a foolproof tool. But it is something that we can use to give ourselves a good ballpark estimate as to what a good buying price would be for us as value investors. And just to compare that to what Google's share price is right now, it says it's at $2,758. So that meets our 30% margin of safety, but not our 50% margin of safety. So according to this discounted cash flows model, Google would be considered a buy right now because its share price is trading at a 30% margin of safety relative to their current cash flows. And we can scroll down here and take a look at what the analysts have to say about this as well. As a number of online users and usage increase, so will digital ad spending, of which Google will remain one of the main beneficiaries, with the bulls saying that there is little revenue diversification within Alphabet as it remains heavily dependent on Google and the state of the search ad space. I think that they both make pretty decent points. Google is definitely very heavily reliant on their ad platform, but they are one of the leading ad platforms in the space, so only time will tell. But I think based on this cash flows model that Google definitely represents a strong buying opportunity right now. So that's it for the video. Hopefully everyone was able to pull some value out of this video. If everyone made it this far in the video, be sure to leave a like on it. It would definitely help this video get recommended to other people on YouTube who are interested in content like this and learning about value investing. Be sure to leave a like and subscribe, and I'll see everyone in the next video.